The Canadian government has unveiled a new plan to protect its steel industry from the effects of U.S. tariffs. On July 16th, Prime Minister Mark Carney announced that Canada will introduce a tariff rate quota (TRQ) on steel imports from countries with which it holds free trade agreements, excluding the United States. Under the new framework, steel imports up to 2024 volume levels will continue to enter duty-free. Any imports exceeding that threshold will face a 50% tariff. Speaking at the Walters Group fabrication plant, Carney stressed the importance of revitalizing Canadian steel production. To build big things again, we need our steel industry to advance, not retreat. He outlined several measures aimed at boosting domestic output, protecting market share, and supporting workers impacted by shifting trade dynamics. Referencing a recent federal review of Canada's steel trade arrangements, Carney announced that by the end of the month, the government will further tighten TRQs on steel imports from countries without a free trade agreement. For non-FTA countries, TRQs will be capped at 50% of 2024 import volumes, with a 50% tariff imposed on anything beyond that. For nations with existing trade agreements, including South Korea and fellow USMCA partners, duty-free access will be limited to 100% of 2024 levels. Any imports above that cap will also be subject to the 50% tariff. Carney also introduced additional duties on steel products containing metal melted and poured in China, signaling the government's commitment to shielding the domestic market from indirect trade distortions. While Ottawa is actively negotiating with Washington, Carney emphasized that there will be no immediate changes to U.S. tariffs. Our existing arrangements with our USMCA partners will remain the same, including no changes to our current trade measures with the United States, he confirmed. Still, he acknowledged the broader challenge. The current trade situation with the United States, combined with unfair practices from other countries, is gutting our steel industry. Beyond border controls, the Prime Minister announced a $70 million investment in labor market development agreements to provide training and income support for up to 10,000 affected steelworkers. The initiative is aimed at equipping workers with the skills and support needed to meet the evolving demands of the sector. To boost long-term competitiveness, Ottawa will commit $1 billion through the Strategic Innovation Fund. The investment will help steel producers launch projects that improve productivity, enable the manufacturing of currently unavailable steel products, and create jobs, especially in sectors like defense. Carney also detailed changes to federal financing programs. The Large Enterprise Tariff Loan Program will see key adjustments. The minimum annual revenue requirement will be lowered to $150 million, the minimum loan size reduced to $30 million, and the maximum loan term extended from 5 to 7 years. Companies must also commit to retaining and reinvesting in their workforce. Carney described these reforms as essential to giving Canadian steelmakers the capital and the time to build the skills, the tools, and the facilities to serve a growing Canada. To stimulate domestic demand, the government will amend federal procurement rules. Companies awarded federal contracts will now be required to source steel made in Canada. Carney concluded by referencing Canada's post-war industrial surge. After the Second World War, Canada built homes, factories, and infrastructure at rates never seen before. Now we must pivot again. For Canada to build big things fast, we need our steel industry to advance, not retreat. The impact on the industry was immediate. Lana Payne, president of Unifor, cautioned, "This is going to have a very quick impact as firms begin preparing for reduced U.S. market access." Tim Zma, CEO of Nova Scotia's Merit Industries, echoed that concern. "We are going to tighten our belt, and we are going to need to watch our costs because we're going to be shut out of the U.S. market for some period of time." Amid those warnings, Carney addressed the House of Commons, stating, "We are in intensive negotiations with the Americans and in parallel preparing reprisals if those negotiations do not succeed." Rahim Malu, managing director of Conquest Steel, shared a more nuanced view in an interview with CBC. "It's very refreshing to hear our belief in the country, economy, and manufacturing sector shared by our Prime Minister," he said. Malu emphasized that Canada could become its own best customer for steel if the transition is well supported. While acknowledging the short-term challenges, Malu praised the long-term potential of the measures. However, he cautioned that combating unfair trade practices will require stronger enforcement. "Dumping has been a challenge we've faced for years, and it's getting worse," he said. While he welcomed the new tariffs on steel melted in China, he warned that too many importers continue to exploit regulatory loopholes, bringing in minimally processed or finished goods and marketing them as Canadian-made. He urged Ottawa to crack down on these practices, especially around raw material classification and TRQs, Such action would be a huge benefit for manufacturers like us and critical to preventing demoralizing knockoffs from flooding the market, he said. On procurement, Malu also emphasized the importance of acquiring Canadian steel in federally funded projects, calling it a key lever for strengthening domestic industry. He noted that Conquest Steel's raised garden beds and other municipal products could easily be manufactured in Canada, and that embedding a federal, and ideally provincial and municipal, requirement to source Canadian steel would be a major incentive and bonus for domestic manufacturers. Reflecting on the past 6 months, Malu described the period as stressful and exhausting, recalling how CSI Manufacturing essentially lost its U.S. market overnight in early 2025 and had to pivot quickly to sustain its workforce. Yet, he emphasized the huge silver lining of strong public support, which he said has encouraged the company to keep pushing forward. Despite the ongoing trade war yo-yo, with hopeful moments quickly dashed and tensions regularly resurfacing, Malu remains optimistic. "I've never believed in this country more than I do now," he said. "We have the potential to become a global powerhouse. Even if we don't thump our chests as loudly as the Americans, hearing our leadership express that belief with confidence means it will be worth it in the long run." Alongside the steel industry, economists praised the government's move and proposed additional measures to secure and safeguard the economy. One Bank of Nova Scotia economist suggested that Canada could strengthen its response to the Trump administration's tariff pressure by barring U.S. firms from bidding on major infrastructure and defense projects. Instead, those contracts could be awarded to businesses based in Canada, Europe, Asia, or Latin America, offering leverage without resorting to escalating retaliatory duties, said Derek Holt, the bank's head of capital markets economics. "There are many tools at Canada's disposal, more passive tactics that don't involve locking horns over tariffs," Holt wrote in a client note on Wednesday. He added that Canadian consumers and businesses can buy smartphones, vehicles, and capital goods from a wide range of suppliers in Canada, Asia, and Europe. That shift would represent a lost opportunity for U.S. exporters. In 2024, Canadian consumers, businesses, and institutions imported approximately $440 billion in goods and services from the U.S., more than from any other country, according to U.S. Commerce Department data. Holt's proposal follows President Donald Trump's threat to impose a 35% tariff on select Canadian products effective August 1st. Despite several concessions made by Prime Minister Mark Carney's government since the trade conflict began, Carney acknowledged Tuesday that Washington has shown little indication of fully rolling back its tariffs. Holt also highlighted Canada's reserves of critical minerals, essential inputs for U.S. manufacturing and energy sectors, as another potential bargaining chip. "The best outcome, of course, is for Canada and the U.S. to remain closely integrated under a sensible agreement," Holt wrote. Failing that, political uncertainty and alternative supply arrangements are a real risk. "It is not in America's best interest to face instability across the Americas, right in its own backyard." To provide additional context and underscore the importance of steel trade between the U.S. and Canada, recent trade data paints a clear picture. In 2024, Canadian steel exports to the United States totaled 6,557,000 net tons, making Canada the largest foreign supplier to the American market and accounting for approximately 11% of total U.S. steel imports. These exports were valued at $7.83 billion for iron and steel products, according to United Nations Comtrade data. More than 90% of Canada's total steel exports were shipped south of the border, underscoring the deep economic integration between the two nations. While export volumes declined by 5% year-over-year, Canadian mills still led ahead of the next largest supplier, Brazil, which shipped 4.5 million net tons. Conversely, in 2024, U.S. steel producers exported around 8 million metric tons globally. Of that, Canada absorbed roughly one-fifth, about 1.6 million metric tons, making it the single largest destination for American steel exports. Those exports were valued at $4.78 billion, with an additional $6.69 billion in articles of iron or steel, such as fabricated structural components, also crossing the border during the same period. This bilateral exchange reflects a balanced and deeply interconnected North American steel trade. Canadian fabricators rely on specialty steels from U.S. mills to meet domestic needs, while American producers depend on Canadian output to support critical downstream industries. Thank you for watching.